Welcome to the Legacy Radio Network. This is the Everything Financial Radio Show. I'm your host, Dennis Tubbergen. I am here every week at this time. Certainly glad you joined me today. You know, we've got a terrific program lined up for you. We have our frequent guest expert commentator, Mr. Karl Denninger, stopping back. You'll not want to miss his appearance here on the program. I'm also going to talk about central bank lunacy. I don't know what else to call it. You know, the central banks around the world, the major central banks around the world, according to a piece put out this past week by Phoenix Capital Research, have printed over $10 trillion of new money and injected it into the worldwide financial system. That's creating inflation, and it's leading to currency and trade wars. So how will this play out? How might you be affected? I'm going to talk about that. I'm also going to take you step by step as to how much money the Fed has actually pumped into the economy and how, going all the way back to 2008 when Bear Stearns collapsed. In Argentina, they have been printing money. Annual inflation in Argentina has been 25%. Now you won't believe what the government has done to try to stem the tide. It won't work because it was tried 300 years ago in another country. I'll share that with you. You won't want to miss that. And also, if you've been to the gas pump lately, you know that prices over the last couple of weeks are up significantly. What's at play here? What's going to happen with fuel prices? We'll talk about that. And the state of Virginia, along with 13 other states, are now contemplating an alternative currency to the U.S. dollar. That's a story that was published on CNN Money this past week. The state of Utah has already put in place provisions for an alternate currency. Is this a growing trend, and how might it affect you? We'll certainly take a look at that. You'll want to stay tuned for that as well. A couple of quick reminders for you. We are now offering a 3-night class, a 3-night program called New Retirement Rules. Given the situation of the current and the status of the current economy, and given how it might affect you and your nest egg, it's just impossible to give you all the information you need to have in an hour, hour and a half. So we have a 3-night class that we will be beginning February 29, and it will be on successive Tuesdays, 3 weeks in a row, 6:30 p.m. to 9 p.m., 7.5 hours of content. We charge $49 to cover the cost of books and handouts. It is completely education. If you'd like to get more information about the class, you can just go to the website, newretirementrules.com, newretirementrules.com, and get more information. There's a video there you can watch, and if there is capacity, you're welcome to sign up for the class. Also, we have a free report that we've been offering for 2013. It's called 2013, The Retirement Rules Have Changed. This is a report that we will mail to you. All you have to do to request the report is go to mybest2013.com, mybest2013.com. Those are the words mybest followed by the numbers 2013.com. The report contains our analysis of where the economy is currently and how it might affect you and your nest egg and what you might want to do about it. So, again, mybest2013.com. Just give us your name and address. We'll be glad to get the report out to you right away. Appearing once again on the Everything Financial Radio Show, I have with me Karl Denninger. Karl is a prolific blogger and commentator and often appears both on radio and on television to give his views on all things economic. So, Karl, welcome back to the program.
Oh, thank you very much.
Karl, let me just jump right in because I think the big news of late, which probably was not surprising to either you or me, was that the economy actually shrank. GDP, according to the most recent numbers, actually contracted 0.1%, although these things are usually revised a couple times before they come up with a number that is considered to be more real. Is this thing really worse than negative 0.1%?
It actually is, but there's a lot of distortion in the data. As people like myself like to say, there's a lot of hair in the number, as in hairball. The problem you have with the GDP number that was just reported is that there was a huge decrease in government spending, specifically defense. Okay, so ex-defense, if you take defense spending out of the figures, GDP was actually up 1.4 on an annualized rate. So you can look at that and say, well, up 1.4 is better than a negative number, right? the other side of it is that up 1.4 is terrible and is insufficient to counteract inflation, because inflation was up at about 2%. So, and then you say, well, but that number's supposedly in there, that, that the inflation is supposed to be in the GDP because it's supposed to be a real number adjusted for inflation. The problem with that premise is that inflation is dramatically understated because of the way that the weighting is done. So what we have here is we have a negative figure, and we also have the impact of the fiscal tightening that has to take place in the government. It's already starting, and it's coming first in defense, because you had all the contractors and the other defense-related industries that that are in front of what they believe is going to be the sequester. And by the way, I think they're right, and that is starting to hit the economy. The real 900-pound gorilla in the room, though, is that you have this number, which is extraordinarily weak. And remember, the economist's definition of a recession is 2 consecutive quarters of negative GDP. And then everybody got a 2% tax increase as of January 1st. And, of course, that is not in the figures because this timing period ended on December 31st. So you're going to see a 2% decrease in consumer spend, approximately, that's going to come about as of now.
Well, and Karl, given that consumer spending makes up over 70% of the U.S. economy, that's a contraction of at least that much again, if this number is correct.
Yeah, and that's the problem, is that we are an economy that is overly reliant on consumer spending. This is one of the things that people trumpet as the great triumph of America, that consumers drive our economic output and economic future. The truth is that what needs to drive it to a much larger degree is investment. But net investment comes from economic surplus. And the problem that we have in the United States is that for the last 30 years, instead of economic surplus, what we've generated is borrowing. We have not taken that surplus and funneled it back into net investment. We have instead borrowed more and more money in order to maintain a standard of living to which we are not able to actually earn. And this is a time that has tried men's souls, so to speak, because for the last 4 years, the government has taken upon itself to replace that which was borrowed funds by the consumer and by business and do it themselves. In other words, they've taken on the borrowing that we can't do anymore because our credit cards are maxed out and our houses we can't go take home equity loans anymore. This is a very serious problem because the government cannot run an indefinite deficit of $1 trillion a year any more than you can personally run a 15-20% deficit in your personal income on a permanent basis. So as we start to see the effects of this consolidation, the truth of what we have done and the damage that we've compounded in the economy is going to become more and more clear.
Karl, this certainly, the unemployment situation is certainly reflective of the overall economy. I read an article in which the economist John Williams, and I know you're familiar with John Williams of Shadow Stats, was interviewed, and he had said that if we calculate unemployment the way we used to, that we have an unemployment rate when you count the people that are no longer considered to be part of the workforce, those people working part-time that would rather be working full-time. He came up with a number that unemployment is about 23%, which is 1931, 1932 levels. What's your take? Is that an accurate number?
Well, I've got some problems with John Williams' methodology. His point is clear and correct to a large degree. The problem is that, like most people that are out there hawking a product, I think he oversells what he's hawking. The biggest issue that you have in the CPI is not substitution in hedonics, which of course is, he makes a big deal out of the changes that were made in the way the index is computed. It's the fact that the weightings are a complete crock. As an example of this, the CPI table says that health insurance is a tiny fraction of a percent of your total household budget. Well, on what planet do you reside if that is what you believe? Okay, I mean, this is the problem at the end of the day, is that we have things like this that are just absolute fanciful nonsense. And a lot of this is driven from the fact that we have these distortions in the health system in particular, which are a very very serious problem. We don't think of health insurance as something that we personally buy if we have a job with an employer because the employer, picks it up and then there's some small deduction out of your paycheck, right? But in truth, you pay for all of it because that amount of money is money that your employer would offer you in your salary were he not to make that payment behind your back to the health insurance company. Yet the CPI index says that health insurance is 0.658% of your household spend.
Karl, let me jump in here and get your comments. We've got about a minute and a half left on Williams' estimate of the unemployment rate at 23%. I know you've calculated this, and again, we've got about a minute left here as to the number of folks employed. Can you briefly comment?
Yeah, I think, I look at a different set of data than he does. I look at the employment rate of the population, and that is the working age population, and then compared against the actual number of people that are employed. And that number collapsed in the early part of the recession. That collapse happened in late 2007 and into 2008. It bottomed in the middle of 2009 as we went into the second half of the year, and it currently is at about 59%.
We are chatting with Mr. Karl Denninger, his website, market-ticker.org. I'd encourage you to check it out. We will continue our conversation with him when Everything Financial Radio returns here on the Legacy Radio Network. Stay with us.